So when we learned about the balance sheet back in chapter 1, right, we had the assets section, the liabilities, and then the stockholders equity section, we only showed two things. We had common stock and retained earnings, and we got the balance for retained earnings from the statement of retained earnings. Well, now we're going to see our stockholders equity section is actually a little bit more involved. The first part of the stockholders equity section is the paid-in capital or the contributed capital, the amount that we receive from investors. And so if your company has preferred stock, it'll be listed here, and a description of the preferred stock will be shown. The percentage we'll talk about in a little bit, the par value, the number of shares authorized, issued, and outstanding. And then the balance, right, from the general ledger, the balance will be shown here. The paid-in capital for the preferred will be listed. And then common stock, a description, the par value, number of shares, the balance from the general ledger, and then the paid-in capital for the common. And all of these things will be added up, and that'll be your total paid-in capital. Then you'll show the retained earnings, and again, this will be the ending retained earnings from the statement of retained earnings. And the paid-in capital and the retained earnings will be the stockholders' equity if there is no treasury stock. Let's talk about treasury stock. So treasury stock is stock that at one time was in the hands of shareholders, but the corporation has gone and bought them back from the shareholders. Well, think about, why would a company buy treasury stock? There could be a few different reasons. Maybe they want to buy the stock low and then sell it higher if the stock price has dropped. Maybe it is to prop up the stock. Okay, because if we think about it, if they buy back the treasury stock and then there's less shares out there, what's going to happen to the shares of stock, right? If you think of the corporation as a pie, let's say the corporation is worth $1 million and there's 10 pieces of the pie. We go and we buy back 2, so now there's only 8 pieces of the pie, right? Every piece of the pie is going to get bigger if there's less pieces of the pie. So if we buy back some of those treasury shares, the share of the market price will go up for the outstanding shares. Maybe they want to acquire shares of stock because they want to have an employee stock plan and they want to be able to distribute those shares in an employee stock plan. So these are some reasons why a company might purchase treasury stock. Treasury stock will not have any voting rights and it will not receive any dividends. So treasury stock will be recorded at cost. So just like we said common stock, it's always number of shares times par. Treasury stock, the amount will always be determined as number of shares times the cost. And the cost is the purchase price. What did you have to pay to acquire those shares? So when we buy treasury stock, we'll debit treasury stock for the cost. We'll credit cash for the cost. Well, here's an example. The corporation purchased 1,000 shares of its $10 par value stock for the treasury, and they paid $15 for a share. So we'll debit treasury stock, 1,000 times $15 cost, credit cash for the same $15,000. After a while, the company may decide to sell the stock again. And when that happens, it can be one of 3 situations. They could sell the treasury stock for the same price they bought it for. So we'll debit cash for the number of shares times the selling price, and the selling price happens to equal cost. We'll credit treasury stock for the number of shares times cost, and these will equal. The second situation that could happen was we could sell the stock for more than we bought it for. So if that's the case, we'll debit cash, credit number of shares times the selling price. Our credited treasury stock, we said, is always number of shares times cost. And then the difference, because the selling price was higher, will go into paid-in capital treasury. The third scenario is the treasury stock can be sold for less than it was purchased for. So debit cash, number of shares times the selling price. Credit treasury stock, number of shares times cost. Now we need a debit to balance. We will debit paid-in capital treasury, but paid-in capital treasury can only debit it up to the amount of its balance. So if the difference between the cash and the treasury stock is no more than the amount of the balance in paid-in capital treasury, then we just debit paid-in capital treasury. But if that amount is more than the balance in paid-in capital treasury, we'll debit paid-in capital treasury for the balance of the account, and then retained earnings will be debited for the rest. So basically, we have to make sure that paid-in capital treasury will not result in a debit balance because of this entry. So let's say on March 1st, we sold 500 of the treasury shares that were purchased for $15 on February 1st. The selling price was $17. So we'll debit cash. 500 times 17 is 8,500. We'll credit treasury stock. 500 times the $15 cost is 7,500. And the difference will go into paid-in capital treasury, 1,000. So now paid-in capital treasury has a credit balance of 1,000. Then, we already did that one. Then a few weeks later, we sold the remaining 500 shares that we purchased for $15. Now our selling price is 10. So our cash is going to be 5,000, the 500 shares times the $10 selling price. Okay. We will credit treasury stock for 7,500, the 500 shares times the $15 cost. So we can debit paid-in capital. Okay, we can see the difference is 2,500, but we can only debit paid-in capital up to the amount of its balance. Paid-in capital treasury has a $1,000 credit balance. If we debited for the full 2,500, it would cause it to have a debit balance, and that can't happen. We can only debit it up to 1,000. So we will do that. Debit paid-in capital treasury for 1,000, and then the rest will be debited to retained earnings. So we've got a 1,500 debit to retained earnings. So that's how treasury stock works. Now, if you have treasury stock, the paid-in capital treasury is going to be shown up here under paid-in capital. Okay. And so again, we add up all of our paid-in capital or contributed capital to get our total paid-in capital, 1,202,000 in this example. We add our retained earnings and we come to a subtotal. But now let's think about this. Stockholders' equity, all of these accounts have a credit balance. Treasury stock, when we bought treasury stock, we debited treasury stock. Treasury stock has a debit balance. So that is why we will be subtracting treasury stock from this subtotal to come to our total stockholders' equity. That's the effect on treasury stock. It reduces your stockholders' equity because those shares aren't outstanding anymore. They're included in this common stock number, but they're not out there anymore. We subtract them down here. Okay, next we're going to take a look at dividends. So we talked about dividends back in Chapter 2, and so we know they're distributed to shareholders to reward them for the profits of the company. The dividend is going to be declared by the board of directors, and once the board declares a dividend, it becomes a legal obligation. So when they declare a dividend, the corporation is going to have a liability. Because usually the board declares the dividend, but it's not going to be paid until a future amount of time. They need time to process the dividend. And so it's a legal obligation from the time they declare it, even though they're not going to pay it till later. They only pay the dividends on the outstanding shares. We already said the treasury shares will not receive the dividend. So in order to pay a dividend, the corporation should have sufficient retained earnings, because the retained earnings is going to go down by the amount of the dividend. Obviously, they need to have enough cash. Usually, corporations pay dividends quarterly. So when the board declares a dividend, we debit cash dividends, right? Because before we just talked about dividend being declared and paid. Back in Chapter 2, that it was declared and paid at the same time, so we just debited dividends and credited cash. Well, we're going to differentiate because we're going to also talk about stock dividends. Dividends aren't all, cash dividends are the most common, but companies may also distribute shares of stock as a dividend. So our dividends account is now going to be two accounts, cash dividends and stock dividends. And they will have a normal balance of debit the way the dividends account did. So we will debit cash dividends and we'll credit dividends payable on the date of declaration because we said they've got a legal obligation to pay it. The amount of the dividend will be the number of shares times the amount set by the board. It's typically when the board declares a dividend, it'll be a certain dollar amount per share. And so it's declared, they'll set a time in the near future when it's going to actually be paid, when they're going to actually send out the checks. But trading can occur. They can be buying and selling shares in between when the dividend was declared and when it's actually paid. So the board will set a date of record. That's the date where the ownership of the stock is looked at to see who is going to receive the dividend. Whoever owns it at the close of trading on the date of record will receive the dividend. We won't make a journal entry because this is just determining whose name goes on the dividend check. And then when it comes to the date of payment, it's just like any other time you're paying off a liability. You debit dividends payable and you credit cash. Just to remind you, back when we learned about closing, we said the fourth closing entry was to close dividends. We debited retained earnings, we credited dividends, more specifically cash dividends. Okay. So that's what happens to the cash dividends account. It will end up reducing your retained earnings. So here's an example. We've got a corporation. It's got 160,000 shares issued, 140 shares outstanding. Now, why is there a different amount of shares issued and outstanding? Let's think about that. Okay. There were 160,000 shares at one point in time were transferred to stockholders, but now there's only 140,000 shares in the hands of stockholders. That means there are 20,000 shares in the treasury. On June 5th, the board declared a cash dividend of 50 cents per share to be paid on June 25th to the stockholders of record on June 15th. So on June 5th, the date of declaration, we debit cash dividends for the 140,000 shares outstanding times the 50 cents, 70,000. We credit dividends payable. When it comes to June 15th, that's the date of record. We don't make a journal entry. That's just determining who is going to actually receive the dividend. Whoever owns the shares of stock at the close of trading on June 15th will get the dividend check. On June 25th, we are just paying off that liability that we set up on June 5th. So we debit dividends payable, 70,000, and we credit cash, 70,000.